Hi everybody, this is Dennis Wilborn, founder of Active Trend Trading. Thank you for taking the time to watch this free video that we do every week. It is a video where we cover the markets. We also have oftentimes have some trades that we might be setting up that you might want to take. But I want to ask you, before you leave the page, as you watch the video, just give us a real quick thumbs up and share the content with somebody else. Leave us a comment. We'd really appreciate that. So aloha, God bless, and mahalo. Okay, good afternoon, everybody. This is Dennis Wilborn with the Active Trend Traders. Welcome to How to Make Money Trading Stocks, Options, and ETFs. It's a webinar that we do. It's a free webinar we do every Friday. I want to welcome you to basically share this information with anybody, or your friends, family, whomever. And if you're watching on Facebook and or our YouTube channel, not only share it, but also please give us a real quick thumbs up. We'd really appreciate that. And comments, we love to talk about stocks and what's going on with that. You can shoot me an email or just leave me a message on one of those areas. So, hey, let's get in there and start looking at what we're looking at for today. And I'm going to turn my video off. Okay, welcome to How to Make Money Trading Stocks, Options, and ETFs. This is Dennis Wilborn. I am the founder and the lead technician for Active Trend Trading. All materials that we do present are for trading purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. I continue to come back. Trading is about waiting for opportunities. It's not, it's waiting for the best opportunities possible, then taking action at a predefined point where on one of the areas you can control with when you're buying or selling a stock. And what are those two areas we can control? Well, we can control when we enter, we can control when we exit. We use our system to make sure that we're protecting we're basically protecting ourselves and managing our risk, and also projecting out where our profits are. Basically, the objective of today's session is just finally actionable intel review at the end of the week, seeking to simplify market decisions so wealth can be multiplied. And basically, the essence of today's session is finally a pullback. The market has been moving almost straight up since the beginning of the year. And finally, will this pullback be tradable? That's what we're keeping our eyeball on. So here's where we sit as of about 9 o'clock this morning. The markets have sold off a little bit. We're still up very nicely for the year. Active Trend Trading, we're basically, I add a little bit to the Active Trend Trading on a weekly basis, and eventually by the end of the year, it basically typically surpasses what the indexes have done. I'm focusing a lot this year on both income and cash flow. And we've got some growth things going on also that I'm going to show I'm going to share with you here shortly. One of the areas of growth is a compounding strategy that I'm working with, Strategy 2. The objective of it, Strategy 2 always had a objective of generating somewhere between $500 to $1,000 per week on an investment of $10,000. And I got to thinking about that. You know what? If we could basically compound at 5% per week, and 5% a week on $10,000 is $500. Well, if we can compound that on a weekly basis, we should, it will help us to grow a small amount of money into a larger amount of money, so you can then build into other types of investments. So this week, took a little bit of a hit, down about $171, but we're still up over 22% for the year. Next week, my target is $611.05. So stay tuned with us on this. If this kind of trading does interest you, though, you can always become a premium member, and I can show you how to do that of Active Trend Trading. And so one of the things I want to call your attention to, thanks to one of our members who called this to my attention. The area of natural gas is an entity that is, one, very volatile, but gives some interesting opportunities going forward. The thing that I'm looking about at natural gas is, from a seasonality standpoint, nat gas tends to kind of just go sideways for the first part of the year and then takes off the second part of the, April, May, June, July, almost through the October timeframe, the end of, in the September timeframe. And if this is in fact what takes place this year, we want to position ourselves where we can take advantage of this move up. What will we be trading in this? Well, there's some really cool ETFs. Either you can trade UNG is one of the ETFs, or you can trade, the other way to trade this is is UNG. There is also a leveraged ETF called UGAZ, U-G-A-Z. That's to the upside. And then there is a DGAZ, which is kind of cool because that is natural gas to the downside. In other words, when it does its little pullback, that these two entities follow along. UGAZ to the upside, DGAZ to the downside. Pretty easy, up, down. And so I'll be taking a look at those entities and how you can potentially take a look at them going into the year. Other areas of seasonality, basically January through March tends to be a little bit of flat for the S&P, for the NASDAQ. We're seeing some weakness. We have to take seasonality in the context of what took place over the last 12 months. As you're very much aware, started 2018, we got a nice big run up around the October timeframe. Then the market sold off, went into bear market territory, and then basically hit its low the day after Christmas, and then rebounded from there, really, really hard, hard and heavy. The market seems to still be, wanting to push to the upside, but is it showing signs that, hey, the party may be over? Gold's another thing we keep our eye on. January, February typically tends to be a little bit of upmouth. Most of the time in seasonality with gold, it will push sideways from March until into the June, July timeframe into early August. And then typically you'll get a springtime rally into the end of the year. This didn't happen last year. Seasonality on gold went flat last year, but it's something we at least have to be aware of because it can provide us potential points in time where we need to be paying extra, attention, like right there. The last 2 weeks in July to the first 2 weeks in August tends to be a period when gold may get a bid. And that's how I use these seasonality charts, just to let you know. Lastly, crude. And I'm talking about the oil, not somebody's behavior. Basically, tends to get a little bit of a pullback into February and then bounces in February into March and all that kind of stuff. So we may be at the time of year where crude may be ready to spring, up to the upside. Follows a little bit of the same type of pattern as natural gas. And so we'll keep our eye on that also. So, hey, next big presentation we're going to be doing is for the Bay Area Moneymaker meeting, is a webinar meeting, April 6th. Be looking at, record profits, preparing for record profits, the spring rally. Normally, stocks, ETFs that follow the indexes tend to go into a rally mode in the springtime. Now, does it happen all the time? No, but if you are aware that there is some seasonality working there, we can, position ourselves to be at least ready. Or if we do get a serious kind of pullback in the March into April timeframe, we can position ourselves ready to go going into the spring of the year. There's a little bit about Brandon and myself. Let's take a look at a couple of charts here that I want to share with you. Okay. First of all, let's start with, I want to come back to Panera Bread, but it's not Panera Bread, it's Palo Alto Networks. I want to come back to that, but I want to start over here with the S&P. Weekly chart on the left, daily chart on the right. As you can see, on a daily chart, we are now pulling back into what we would think would be support. Note that the TSI daily basis is pointed in the down direction and approaching its lower oversold condition, while the price action is approaching this level of support at around 270. Of kind of more interest to me, if we finish today where we are, we were basically at the 8-week moving average, which is a little bit less than the 50-day moving average, but this is a pretty significant candlestick right here on a weekly basis. As you can see, last week we finished with which I wrote about and talked about last week, is we finished with a hanging man candlestick, which is a bearish reversal signal. It was voided first thing on Monday, but then lo and behold, the market just ripped to the downside. Now, this candlestick here is a significant, large sell-off in the aspect of a bearish engulfing pattern. And why do I say it's significant? Well, this bearish engulfing pattern on a weekly basis engulfed 1 week, 2 week, almost 3 weeks worth of upside. So the basically once we bounced, kept up there in the 280 level, $280 resistance area, the sellers, probably a lot of profit takers, said, you know what, it's time to just take some profit. Let's get this out of the way. Now, if we continue to proceed down from here, well, we'll look at a 270 level, probably 265 or 266 is the next level. However, look what's also happening here. And I'll spend a little bit of time here. TSI weekly looking like it wants to cross over. Now, what can happen often is you can get the TSI, pencil here, is you'll get the initial, what looks to be a crossover, but price action can continue to move up. Now, this big selling action, that's something to pay attention to. Because look what happened, at the end of, last year in the October timeframe. It started to tip over, then came back and retested, then it tipped over on a weekly basis. Now, if this continues to break down into next week or pulls in, what I'm looking for, if I first get a pullback into the midsection of this week's candle, which is a price level of, let me get my, there we go, which is right, price action right there about 275-ish. If I get a pull back up into around 275, I want to be taking a real hard look at, does this mean we're going to roll back over and drop? Because, what does that correspond to? That corresponds to the 8 and 20. If they continue to fall, okay, they're in basically now sell-off mode. As soon as they cross, that will provide an excellent area of resistance, where if we get a pull up back up to 275, we might be looking at, that would be a great place to buy some puts on, out maybe 6 to 8 weeks out to let spiders fall from there. And then we would anticipate breaking through the 50 and going on down. However, the 50-day moving average, that tends to be a strong level. If we bust through that on significant volume, then all bets are off. All bets are off from there. Our buddy Q, the Qs, Q. I think we're going to see kind of a similar type pattern here. And the answer to that is yes, we are. As we see, we're basically pulling back into the moving average. The other thing that makes this kind of a pullback very significant is that this pullback is much larger than the pullback here, or the pullback here. And so what's happening is the symmetry of these two pullbacks where you would pull back and then get a bounce. We may get a bounce, but this is still a larger pullback. Therefore, it could have some more bearish overtones. Now, I'm not saying we're going to, run for the hills, but it could have some more bearish overtones. If the candlestick on the weekly basis stays where it's at, bearish engulfing, again, look at the midsection of that candlestick for hidden levels of resistance. And that's about the 172 level. And sure enough, the 172 corresponds right exactly with the 200-day moving average. Well, throwing in IWM. IWM. And get rid of the fib. Some people don't like fibs, and so I will remove the fib so I don't unnecessarily offend anybody. Anyway, the IWM is acting a little bit acting weaker than the other indexes. And it already did its little test where it fell, popped up, did a little bit of retest of the old highs, and then dropped. Has dropped down nicely to the 50-day moving average. Again, I'm not going to short it here. I'm not going to try to get, but what I'd be looking at is it may very well then just do a nice little pullback back up into the 820 combo, and that would be our place to say, okay, from there, we're probably going to fall from there. Where do I want to take? Again, put my approximation is somewhere between probably 154-ish, maybe a little bit less than 154. Let's say 153.70 or 80 up to 155. We get into those areas, that's where, and it starts to look like, hey, it's time to roll over again. Anticipate a move down to the downside. Now, if it breaks below this, automatically below the 150 level, then we're probably going to tack off the 145 and then 140 after that. The IWM tends to run in blocks of about $5. So just, put that, make a little note to yourself about that. So once it hits, like it almost hit the 160 level, it stalled or stopped just shy of the 155, and now we're stopping just shy of the 150, but again, in blocks of $5. Here are two stocks. Here I'm going to show you 4 different stocks. One, Adobe. It lets you be the judge on these. Okay, Adobe finding support at the 50-day moving average and the 200-day moving average. Earnings on the 14th after market close. And so a person could look at nibbling a little bit here. I mean, if it gets a retest back down here to the 50-day moving average, you may say, hey, I'm going to pick up a couple of some shares there. Or you can say, hey, I'm going to buy the, say, 152.50 or 150 call that expires next Friday, and let the implied volatility increase and take, because we may get into a little bit of a pre-earnings run. And the way you work the trading run is you can set, buy it here and then close it before the close on Thursday. Or if it gets up 5%, close it then. And what is the upside potential for this? Let's just take a real quick. If it ran back up to this past high from current levels, from there, up to the past high, you're looking at about 5%. So that would be your trigger to say, hey, I'm out of here. So there's one potential for you. Second potential for you is our old buddy Palo Alto Networks. I like Palo Alto Networks because, one, earnings is behind us. It is finding support at the breakout level of 230. So, and going into the end of the into next week, which is the monthly option expiration, tends to have a little bit of a bullish bias. Downside on this is we get on the weekly chart, as you can see, the TSI and the indicators are out of rhythm with each other. On a weekly chart, the TSI looks like it's wanting to break down off of a bearish engulfing. However, again, it's at a level of strong support from the breakout there at the 230 to the 235 area. So do you nibble a little bit here? And if it breaks below the 230 level, that would be your point to get out. That's one of the ways you could approach this. Our buddy Amazon. Hello, Amazon. Amazon has come back down and refound. Okay, Amazon on a weekly chart looks like it wants to continue to fall down. It has just been chop right here around the 116 level up to about the 1600 to the 1700 level, which you think, oh my gosh, that's $100, but on a $1,700 stock, that chop is about. How much is that chop? About 6 to 7%. So it is approaching a level of support. However, we're not getting any indication from the TSI on a daily or weekly that it wants to reverse. As a matter of fact, on the TSI on a weekly chart, looks like it wants to fall a little bit more. So the way I look at doing that is if I drop below today's low, or if it comes up and retest at the midsection or just below the midsection of today's candle, which is a bearish engulfing, that may be an opportunity to get short on Amazon or do something to the downside on Amazon. The other one is Netflix. Netflix was looking really serious this morning. If you're looking to trade something to the downside, Netflix may be your, we are really close to an 820 moving average cross down. And then once that happens, that becomes a really good catcher for resistance where price action moves back up into it, reverses down, and away it goes. Strong support at the 340 and also the 100-day moving average at about 330. So, and then the last two that I had wanted to share with you really is the deal with, well, that's not it. Sorry. Natural gas. Natural gas, remember the chart on natural gas, which it showed last year, towards the end of the year, it would tend to get a run. Well, as you can see, it got one heck of a run last year. In April, bounced up, retested, bounced up, retested, and then bam, took off. $23 and, about $24 all the way up to, do that over here. From this level, So I went on a really quick run of about 50%. This is on the non-leveraged. Right now, we've had a crossover on the 820, which is positive. And so some people may want to look and say, any kind of a retracement back to the 8-day moving average, I would want to take a trade on this with the anticipation we're going to continue to move higher. The longer-term market forecast is also looking higher. Or you could look towards the UGAS. And what did it do? I mean, and this is a, and again, this is a very volatile entity. So it needs to be played with tight stops. But once it gets, once it starts to go like it did last year, it ran up a little bit over 300%, a very, very quick one. Now, I'm not saying we're going to try to capture all of that because that's just silly. But if it goes back up into past resistance, that could still be a significant move. So what's going on over here? A little bit different. I'm watching, but anyway, UGAS, it operates. I tend to want to look to trade this off of the intraday chart. And I'll be going over this with the premium members afterwards. And the opposite side of this is degas. Like if natural gas gases out, well, come on, that's not it. If natural gas gases out to the downside, well, then degas will be going in the opposite direction. There we go. And it's right in a position right now where, TSI looks like it's trying to turn up. But again, the daily TSI, the weekly TSI are out of sync with each other. So if we get a cross down in the daily TSI, that's typically a stronger signal. So watch that instead. So, hey, I'm sorry for going a little bit over today, guys, but I wanted to cover as much as I could. Some excellent ideas going into next week, especially Adobe and Palo Alto Networks. And also you provided some trigger points that you maybe want to look at for the indexes themselves. So without any further ado, let's see, I got a couple of questions here. So hold on a second. Sorry, Barry, I forgot to tell everybody to. Oh, congratulations. In May, huh, for a wedding. Cool, coming to Hawaii. If I bought Palo Alto Network now, where would you put your stop? That's a great question. I'll run over that really quick. The easiest place to put it would be just basically give yourself maybe a percentage below the 230 level, and a percentage point below 230 would be 227.70, which would be down in this area here. Or you could just basically say, hey, I'm going to buy it now at 234.33. And if you wanted to use a standard 4 to 5% stop loss, that would use a 4%. That would put you out at $225. And $225 would actually be back down in this area here. And so, yeah, that's a really tough one. I'd almost rather keep my stop just immediately below the 230 level than down here, because that 225 level would be an area where you'd anticipate it bouncing. You would anticipate it bouncing. There you go. So, okay, guys, ran over time a little bit, but thanks for leaving that question, Barry. I appreciate it. God bless everybody. Aloha. Have a great, awesome weekend. Remember to spring forward. Daylight savings time is my least favorite time of year, because in Hawaii we have no daylight savings time. And so to adjust, I have to get up an hour earlier than I normally do, because the market opens now an hour earlier than it did this week. So anyway, with no further ado, God bless everybody. Have a great weekend.